Back in 1977, driving a yellow taxi through New York City at night was a solitary, grueling existence. The people controlling the financial markets operated miles away from those empty streets, relying on Ivy League degrees, legacy wealth, and generational connections to secure their positions. Bruce Kovner was a 32-year-old cab driver with zero capital, zero connections, and no formal job in finance. Yet, during the long stretches of isolation between nighttime fares, he sat under the cab's dome light and obsessively studied complex commodity price charts. Because he lacked any institutional backing or firm sponsorships, entering the market required him to take a highly dangerous all-or-nothing financial gamble. He extracted a $3,000 cash advance directly from his MasterCard to fund his very first market trade. Borrowing money at high credit card interest rates to trade futures carries extreme consequences. A single miscalculation guarantees absolute financial ruin. That highly precarious transaction eventually built a personal net worth extending deep into the billions of dollars. How exactly did an amateur day trader use a $3,000 credit card swipe to engineer one of the most successful and secretive hedge funds in Wall Street history? Kovner was highly intelligent. He entered Harvard as a National Merit Scholar before unexpectedly dropping out before graduation. He spent the next decade moving through a series of eclectic, directionless jobs. He staffed political campaigns, worked as a writer, and even studied the harpsichord. Traditional Wall Street analysts are trained to view markets through the same institutional lens. Kovner's chaotic resume shielded him from that groupthink, priming his mind to recognize highly unconventional patterns. He built his own curriculum in the driver's seat, teaching himself the mechanical operations of copper, interest rates, and agricultural futures entirely without mentors. His identity as an outsider gave him the exact psychological framework required to analyze global macro markets without institutional bias. He deployed his borrowed $3,000 into the copper and interest rate futures markets to test his self-taught theories. These initial trades yielded modest profits, proving his theories worked and giving him the confidence to scale up his risk. He then pivoted to the soybean market, which was in the middle of a severe, genuine supply shortage. This timeline chart starts at a baseline of his initial $4,000 stake. As the supply shortage drove prices higher, he executed a strategy of asymmetric risk. We can see the exponential explosion of his wealth here, jumping to $45,000 in weeks. His execution proved he had mastered the calculus of risk and reward. The nighttime cab driver was now a legitimate market force. $45,000 served as the essential seed capital that allowed him to abandon the taxicab and trade the markets full-time. He took that initial capital and eventually founded one of the most successful, fiercely secretive hedge funds in the world. Over the course of the following decades, his personal net worth climbed well into the billions of dollars. Building extreme wealth in the financial markets demands obsessive focus and the courage to take a calculated asymmetric risk when you locate an edge. But relying on intense leverage is a high-wire act that leaves absolutely no room for error. The credit card trade made him rich, but a near-fatal mistake made immediately after this victory taught him the strict rule of risk management that ultimately protected his $8 billion empire. Bruce Kovner is sitting on a massive, perfectly timed fortune. In exactly 60 minutes, half of it will vanish. It is 1977. Kovner has identified a genuine shortage in the soybean market. His entry was impeccable, and the profits are piling up, but his strategy has a structural flaw. Kovner has a brilliant read on the market's direction, but he lacks any mechanical risk controls to protect the gains he's already made. Identifying a trend is only half the battle. Without an architectural system to extract the money, paper gains remain a temporary high score. The soybean shortage corrected abruptly. Prices reversed, and the market turned violently against Kovner's position. Faced with a steep drop, Kovner experienced a common psychological failure. He froze, abandoning his plan as the red numbers climbed. His rational analysis gave way to emotional dependency. He stopped trading on data and began holding his position based on hope. In a single hour, his $45,000 position was slashed in half. His hesitation to act had a clear financial cost. He finally sold, escaping with 5 times his original stake, but the experience left him physically ill for days afterward. Kovner learned that long-term survival depends on weathering the volatility of a correct idea, a test he was psychologically unequipped to pass at the time. Despite walking away with a profit, the trauma of the hour left Kovner physically sick. Most beginners walk away from a 5-fold win with reckless overconfidence, or they are destroyed by the suddenness of the loss. Kovner chose a different path. He stripped the emotion from the event and treated his own hesitation as clinical data to be analyzed. The math was clear. The most accurate market forecast provides zero value without the mechanical discipline to protect the capital once it's deployed. Mastery required him to decouple his ego from the trade and objectively diagnose his own psychological failures. Following the devastating soybean trade, risk management became the absolute core of Kovner's strategy rather than a mere afterthought. Before calculating potential profits, Kovner defined exactly how much he could tolerate losing on every single position. Entry into a trade was strictly forbidden until this worst-case scenario was mapped and deemed bearable. By forcing mathematics to dictate the terms of engagement, Kovner removed hope from his operating system. This new, cold, rules-based discipline caught the attention of Michael Marcus, a legendary trader. Marcus brought him into Commodities Corporation, a Princeton-based incubator known for its rigorous, systemic approach to the markets. Under Marcus's mentorship, Kovner merged his ability to read global economic trends with an unyielding technical discipline regarding entries and exits. This professional edge came from the synthesis of sweeping global theories and cold, mechanical execution. In 1983, Kovner founded Caxton Associates, a firm built entirely on the discipline he had refined over the previous 6 years. Caxton specialized in global macro trading, taking positions across currencies, interest rates, and commodities based on broad shifts in the economic landscape. No matter how large these global bets became, every position remained protected by the same risk parameters forged during the crisis of 1977. Caxton Associates grew into a multi-billion-dollar firm by prioritizing a system designed to survive being wrong over the pursuit of perfect prediction. Think of a 1980s trading floor, and you likely picture screaming brokers, ringing bells, and paper flying everywhere. It was an environment defined by sheer volume and aggression. Yet, right in the middle of that era, one of the most profitable financial operations was running in near total silence. They gave almost no interviews and actively avoided the press. This graph tracks Caxton Associates. Their flagship fund generated an average annual return of 21%, double the S&P 500. Filling the space beneath that curve reveals the operation's scale. At its peak, Caxton managed over $14 billion. The architect behind those numbers was Bruce Kovner. Even among fellow billionaires, he was notoriously private, keeping the specific mechanics of his trading closely guarded. In 1992, while still generating massive returns, he did something highly unusual. He locked the firm's doors to new outside money. He chose absolute control over unbounded growth. The scale of Caxton's success points toward a strategy built on something more rigid than simple market intuition, a hidden architecture that allowed Kovner to operate with a precision his peers lacked. To understand that system, we have to rewind to the physical, high-stakes trading world of the late 1970s. In 1977, early in his career, Kovner identified an impending shortage in soybeans. His analysis of the market was entirely correct. He bought in and rode the resulting market volatility to a massive $45,000 paper profit. But when the market rapidly shifted against him, he froze. He had a planned exit strategy, but in the heat of the moment, he hesitated to execute it. Over the next 60 minutes, he watched helplessly. His inability to act under pressure wiped out half of his entire gain. Kovner walked away from that desk realizing that even when your conviction is right, your lack of a mechanical exit can still be your undoing. That painful loss forged his entire operating system. He stopped obsessing over potential profits and focused intensely on containing his inevitable losses. As the markets entered the 1980s and 90s, they brought a relentless wave of global volatility. Currency crises and recessions routinely wiped out highly leveraged macro funds that lacked strict discipline. This diagram shows his solution. Before trading, he defined his maximum loss, drawing a hard boundary around every position. If a trade fit that boundary, it was automatically cut. But if it broke upward, gains compounded aggressively, unconstrained by the floor below. This rigid risk architecture allowed Caxton to survive events that ruined entire institutions, including the massive 2008 financial crash. Caxton survived and thrived for decades because Kovner mathematically defined his exact risk before he allowed himself to think about the reward. In 2011, after nearly 30 years guiding Caxton, Kovner quietly stepped back from active trading. He transitioned to running his own family office, managing a personal fortune that had grown to $8 billion. The reality is that every investor and entrepreneur eventually faces their own version of that 1977 soybean trade, a moment where the market moves against you and panic sets in. Legendary careers are defined by a specific type of resilience, ensuring that when a mistake inevitably happens, it is contained by design rather than left to chance. Over a 40-year career, quiet, mechanical discipline consistently outperformed raw prediction. True financial endurance requires looking closely at your own psychological limits and hardwiring a system to define your risk before you ever define your reward.